we have been sitting here thinking for a while, and at least Dennis has been talking about it too, that margin compression to come back. And if you're not up on your game, it's going to bite you hard.
Yes, sir.
So I'd like to get you said some provocative things to me in your email responding to this. So if you could, Ed, paint the picture of this again, when you think it'll hit, how severe it'll be, what kind of dealers are going to be caught in trouble with this.
Okay.
And then we think, and you may have some different thoughts about it, that again, if you've gotten sloppy during the fat times, if you've let your processes slip, if you got overconfident, you might have some trouble. So that's kind of the things maybe you can touch on. So I'm going to turn the mic over to you.
Okay. Thanks, Jim. The indicators are that, and the projections that are coming out at the end of this year simply state that by the end of March, there will be another 1 million new vehicles available for sale on dealers' lots. So on December 1st, Jim, there were 1.3 million units nationally new. They're going to be somewhere in the neighborhood of, you're going to have another million. So you're going to have let's just call it 3 million to 2.5 million. There are two folks projecting worth of new vehicles on the ground. So you add another 1 million cars. It doesn't sound like a lot, but you're doubling essentially the inventory that we currently started the month of December. And the sales rate will probably not increase by 1 million units, because the rate of sales has sort of adjusted itself to where the SAR is going to come in at about 15 million. Well, with that being the case, now all of a sudden, with another 1 million new cars on the ground by March, the end of March, the 1st of April, that's going to change the dynamic dramatically of the late model, let's just call it 2 years old and newer vehicle that has been selling for within, $1,000 or $2,000 of what a new one is. That alone, Jim, is going to change the dynamic of pricing, and it's going to change the dynamic of margin compression, because those vehicles will need to be, those 19 and newer, 2-year-old and newer, will need to be liquidated through the retail channel. In other words, you cannot wholesale them again. There's been so significant amounts of wholesale recycling, where a dealer in July would have bought a car, didn't sell it in 120 days, takes it to the auction, sells it to another dealer who sits on it and recycles it through the wholesale channel again. And it's sort of like the game of musical chairs. When the music stops, and the music's predicted to stop by the end of March, the 1st of April, there's going to be some dealers that don't have a chair. And that chair is going to be that 2020 that they have within $1,000 or $2,000 of what a new vehicle is that they currently sell. And boom, all of a sudden I've got 10 in stock new, where I had 1 in December. It's going to be painful for the dealers that don't take advantage of retailing those vehicles now. And so the answer to your question about margin compression is simply this. Any vehicle that is in stock in a dealer's inventory today that has a 32 to beyond cost and is 2 years old or newer is at risk. And the profits that we've all enjoyed are not going to be able to be enjoyed on that car as you liquidate it through the retail channel instead of liquidating it through the wholesale channel, because there will not be buyers for those cars through the wholesale channel.
Why is that? Because they're priced too high?
Priced too high, yeah. The prices are already gradually weak. the sell-through rate at the auction dropped to 65% last week, and it had been running as high as 79.
Okay.
That's sort of a pre-indicator, Jim, of what the climate's going to be. Now, part of that seasonality with December, but it's still a pretty dramatic drop. That's 14 points.
So let me capsulize this in my own words, make sure I understood it. So the new car inventory start coming in. The delta between them and certified or whatever these newer cars are is pretty narrow, a couple $1,000
or less in some cases.
Or less. So buyers are going to start instead of looking at great values in these CPOs compared to I can't get a car anywhere else, are going to look at it and go, you know, honey, if we just pop up another 1,000 or 800 on this, we can go from this 2020 to this brand new 2022 or whatever.
Correct.
So that's what it's going to be. All right. So that's going to leave fewer buyers for these new used cars on their lot.
Yes.
And we'll call them their newer used cars. I think you said down to model.
Yeah, I'm 2019 and newer is where I think the most significant risk is for two reasons. One is there's fewer buyers for those. And the reason, Jim, on that is because, frankly, the price increase has squeezed the affordability factor completely out of those late model cars. They're unaffordable.
Yeah.
And banks, this is the other thing that's happening, another pre-indicator, are starting to look at LTV, which is loan to value.
Yeah, I was reading something on that yesterday.
Yeah.
They're talking now a lot about margin compression.
Oh boy. And what they're looking at is their portfolio of loans and going, how many of these are we going to have at risk going forward? They're not looking at January, February, or March. They're looking at 2022, 2023, 24, and beyond. So, you really have to, I think the biggest thing that worries me, Jim, is we have too many dealers that are thinking short-term and locally. They're not thinking long-term and regional. And boy, that's just going to kill dealers. And when you think short-term and locally, you've defined your business by what's happening in real time. And as quickly as it changed in January of 2021 to where prices were on the increase, I think we're going to see a general slide. And the reason I say that is because Manheim's used vehicle index, the projection by Manheim is the used vehicle index, which is the index that everybody uses. So think of MMR. It's projected to peak between January and April. And it's been on a steady rise since essentially late January, early February of a year ago.
Mm-hmm.
And with it peaking, that means it's going to start coming down, and we're all in for a rude awakening by the end of Q1.
So
we got to take action now.
And that action would be what? Let me just throw out one that I think I heard from you, is I need to look at my used cars on the lot that kind of fit the
risk profile,
the risk cars,
right,
and either start pricing them now to move.
Yep.
So that, and I don't know how much of a change that might mean. So when this thing hits in the first quarter, I've either moved them off the lot or I've reduced them enough,
right, to
be competitive.
That's job one, is don't have any of them don't have any vehicle by the end of March with December money, because the March money for that vehicle will be a lot less than the December money was.
Yeah.
And essentially that's only 90 days, Jim. That's the other thing that, frankly, you mentioned disciplines. What I'm seeing is, it's interesting you brought it up, because this is exactly right. The disciplines of running a well-managed used car operation have sort of been thrown out the window. And one of those that started was aging. Where many dealers manage their aging very closely. During 2021, Jim, what I'm seeing is dealers sort of threw all their aging out because they had to pay more for a car during this 40% increase in 12 months than they could sell it for. They were paying more wholesale than they were selling them for retail.
Right.
And
Yeah.
so, and so consequently, they just threw their aging policy out by going, well, gosh, I got to buy one and pay way more than I would if I liquidated. Well, now you're going on the other side of that mountain and the sun isn't shining. Aging is a policy you need to start looking at quickly, especially with those risk ones. The other thing that is really interesting to me is no one is even talking about it anymore, and it's going to become acute, is holding costs. These cars that are sitting there for 90, 120 days, and you didn't do anything about them, and now you didn't have to worry about holding costs in July because you had grosses that were outstanding.
Yeah, and
Well,
you liquidated them right away. Yeah.
Yeah, and you start repricing them now in January and February of 2022 with a completely different market, with affordability being squeezed out and banks looking at LTV. All of a sudden, my grosses are a lot less. Well, that's because you've got old money in a new market, and that old money in the new market is the margin compression for 2022. If I could put a headline to your article, it would be old money is margin compression. Old money in a new market is a margin compression killer. It will. My biggest fear is it's going to put some guys out of business because they were reckless with their purchasing, and they've got a 2019 or a 2020 with basically the cost of a new vehicle in it. New vehicles start to come in. Consumers go, wait a minute, I can get a deal on the new one. I can't get a deal on the used one. You're left with completely frozen capital unless you do something with it now. And that statement I just gave is, old money, new market, kill you.
Does this audience, are they going to know? I think they are, because you use the term, what old money means here. You're not talking about money from grandfather. You're talking about.
No, I'm talking about old money from a vehicle that you purchased in December.
Right. Okay.
That has a January or February market value of less than you bought it for, right, because you're on the decline.
Yeah.
We've reached we've ascended to the top of the mountain. I don't think anybody in our industry has any belief, Jim, that we're going to continue. Used car prices went up 40% year over year. We're not going to have another 40% increase.
Yeah.
In fact, I think we're going to see a pretty significant increase.
Yeah. So,
and it's being driven by the consumer's checkbook. These people are voting. They're voting with their wallet, Jim. The customer is saying, I don't want to pay that much for a 2-year-old car when I know I can get a new one for just a little bit more, to your earlier point.
But are the consumers trending ahead of this, that they know this is changing and they should hold off?
They've been driven away by prices.
Yeah.
Well, that's why shopper counts are down, Jim. The shopper counts on AutoTrader and Cars.com and TrueCar and just the general shopper counts are off. And inventories are actually, there's more inventory listed with fewer shopper counts than there has been all year.
So, explain that to me.
Okay, so if you look at the AutoTrader listings, let's say in the summer, let's say in July of this year, there were 1.6 million new cars listed. Now, all of a sudden, there is 1.9 million new cars, but fewer shoppers looking for that 1.9 million. So increase in inventory, decrease in shopper count is a clear indicator that the market's starting to cool. Vehicles listed for sale versus the customers actually shopping for a vehicle on that given site.
Well, how quickly would that turn around if because I understand they've been beaten away from shopping because the price
Yep.
disparity just been, I'm
Yep.
not going to go there.
Yep.
I guess my question is partly is this: how savvy or are consumers aware that we might be seeing this influx of new cars coming in? Because all through COVID, my wife and I sit here and we go, how come we've got all these new car commercials, and we go to drive by our lots on our streets here and they're all empty.
Yep.
So I don't know whether, yeah, I mean, I can't argue with the shopper count and all that. I
So
guess
the reason you see that is for two reasons. One is the manufacturers are in the business of building cars. They're also in the business of keeping their brand recognition high.
Right. Yep.
And you're an old marketer, so you know that the minute you go dark is the minute you're forgotten.
That's true. Oh gosh, that's true.
And so, I mean, the best example I can make this year is Toyota with historically low inventories. Still had a Toyota phone at the end.
I know.
And it was purely done for brand recognition. Because if Toyota didn't have a Toyota phone, what does that say to the humanity?
Yeah, that's right. That's right.
And oh, by the way, Toyota is, I'm sure you probably read this, Toyota is going to build 880,000 cars in the first 6 months of next year.
Oh boy.
We're going to see inventory, Jim. We're going to see inventory. And it's not all going to be desirable. In other words, it's not all going to be, Tahoe and F-150.
Right. Well, they're going to have to build some of the other stuff. I mean,
yeah, they have to. First of all, they still got CAFE requirements.
Yeah. And
the other thing is that they're bound by, many of these UAW contracts, you got to keep the plant running at 90%. So, we're going to see the less desirable vehicles get built, which also means incentives.
Oh boy, up the incentives go.
Yeah. So all of a sudden, this thing's going to turn and get normalized quicker than we'll wake up and say, wow, that was fast. When in fact, it's going on right now. We'll just see the net result of it in March or April.
So when you say normalized, are we seeing pre-COVID market normals, or where are we going to see this?
Okay, so I would submit to you that if you looked at the last quarter of 2020, so October, November, December of 2020, that was a more normalized market. In other words, used car prices were depreciating, not appreciating. There was new car inventory not at its highest level because we'd gone through the summer selling season of 2020 and had plant closures. But if I could parallel it, Jim, it would be, think of where you were in Q4 of 2020 and benchmark yourself to be there again by the end of Q1 2022.
So again, back to that's very good and detailed. Thank you, Ed. So when we get back to the topic here of margin compression, can you outline for me some areas where we're going to see it? We did mention holding costs, which is
we're going to see it in reduced gross profits on used cars, because you're going to have to sell these vehicles for less to move.
How much do you think that's going to reduce across the board?
My speculation is it's going to be somewhere in the neighborhood of 10%.
Okay. So you've got to make those adjustments.
Yep. Yep. And I would also tell you that they're going to have to make some adjustments in the way that they were reckless with the acquisition of vehicles. Margin compression starts when you buy it. The disciplines of acquiring a vehicle, I'm finding a lot of misbehavior by dealers right now. they're so determined to buy cars that all the disciplines of accurately purchasing them, accurately getting them through the recon process, accurately acquiring the right vehicle, not taking a chance on a vehicle. Those are all contributors to margin compression.
Sure.
But it starts when you acquire it. And there's just a lot of misbehavior in acquisition.
I think that's part of what Dennis has been talking about, the sloppiness.
He's right.
Not in the recon, but the whole.
Yeah.
We always said good recon starts when you buy the cars. And
correct.
So where other places has all that's happened in the last 18 months maybe taken our eye off the yardstick, that we might end up seeing other areas where we start seeing losses?
I'll give you another piece of sloppiness is the digital marketing aspect. Crappy pictures, descriptions that aren't any good, all will contribute to margin compression. Where you didn't even have to have good pictures or a description on a car. You just put it on the internet. Somebody called within 5 minutes and bought it.
Yeah.
Now you have to have your disciplines in your digital marketing. The other thing that I see is the disciplines of training your salespeople on the benefits of a fully reconditioned car. All been eroded because everybody was so busy when customers were saying yes that we very seldom had to overcome any objections on, is this a good car?
Yeah, that was a big, I think, a big discipline, what's the right word, divot that happened, because I mean, people, you didn't have to sell, you just had to write down what the guy wanted and give it
You
to
just
him.
you had to be able to accept his money and say yes.
Right. That was the deal. You got the money and the credit.
Yeah, right.
So when you look across the board, Ed, who are the dealers? I don't know if you can define them, but who are the dealers who are going to have the most challenge by this back to normal?
Okay, I'll start with one simple statement. Any dealer who abandoned their aging policy in 2021 is at risk. Large, small, multiple rooftop, publicly owned, any dealer that abandoned their aging policy.
Okay. How about, I don't know how much trade activity was going on during the last 18 months, but so part of my question may be moot. Did trade look the book and trade? What's your term that you trade?
Yeah, appraisal effectiveness.
Appraisal effectiveness. Did we get sloppy in that area too?
Very sloppy, because we ran to a car that we wouldn't have normally overappraised, and overappraised it just to get it. That's a huge slop in the chain, so to speak.
Yeah.
And I would also tell you that the efficiency and disciplines of accurate appraisal economics, and when I say accurate appraisal economics, lots of dealers threw the market reports out because the market was changing faster than the market report could keep up. And so consequently, they now are not looking at market reports. And as the market begins to stabilize and in fact go down, the market report's actually going to become even more important, because you won't be able to underappraise it fast enough. So the disciplines of having that appraisal effectiveness when it comes to what data points am I going to use when I appraise a vehicle, and what are the data points that I'm going to use to acquire vehicles, all need to be revisited, because we just became reckless. We just said, it doesn't matter what we have to pay for it, we have to have inventory. Well, in a market that's turning, that statement will get you in a lot of trouble.
So how about the guy that says, well, I pay a lot of money a month to have V Auto or First Look or AAI or, you know,
Right.
so I'll let them keep up with this.
You know, it's interesting because V Auto only scrapes current inventory and looks at the data of what got sold, not necessarily, and what is for sale. Not necessarily does it look at trending. It looks at trending in 2-week periods. You need to be looking at trending almost on a daily basis in a market that's changing.
So who in the dealership, and maybe this depends on the size of the dealership, is responsible for having the assignment, the accountability, the awareness, the intelligence, the forethought to grab hold of this data and start doing these things? Is that a dealer principal role? Is that the GM? Who is it?
I think it's a team. You know, it's a little like signing a two-party check. I encourage dealers right now to have 2 signatures on an appraisal, one of them being the used car manager or whoever's in charge of liquid or retailing that inventory, and the second one being someone in executive leadership, that either be a dealer principal or a general manager. And a 2-party signature appraisal process right now might slow you down just a little bit, but take those extra 2 or 3 minutes instead of having $2 or $3 million worth of cars you can't sell. So a 2-party appraisal process, one executive leader, the other one being whoever is charged with the disposal of that vehicle. And that's normally, Jim, the used car manager.
Okay.
A lot of money at risk right now, Jim, in the market.
That's what I'm gathering. A lot of money.
A lot of money. There's a lot of money at risk.
Off a sidebar on that for a minute. So we've got all these groups that have been almost drunk punch, buying all these cars up, and suddenly now I would guess some of the I forget the word they use there, the variables or whatever that they look at to make these evaluations.
Yep.
Some of those models not going to work out well or upside.
Yeah, shift is in danger. All you got to do is take a look at a 52-week trend of shift. It's a publicly traded stock, SFT. You can look at them and look at their trending over a 52-week period. They're at risk. Vroom, the same way. Take a look at their stock over a 52-week period. It's an indicator by people way smarter than you and I, meaning Wall Street, that they don't like the model that they're in.
Yeah. Well, how about guys like, I think Lithia is public, isn't it? Lithia
is public.
AutoNation.
AutoNation's not at risk because they were conservative all the way through this. So they didn't have any high highs or low lows. Lithia is less at risk because they have a very strong balance sheet. And what they've done is they've gone out and acquired a bunch of locations. They can spread their risk through, they're going to be the largest retailer. They're going to pass AutoNation in 2022 with most locations.
Well, they're on that track. Yeah,
they sure as heck are. And, Asbury's the same way. Asbury's a little reckless with the way that they're acquiring vehicles or acquiring dealerships. They're paying way too much. But I also know that the brands that they're acquiring, they've gotten very focused on luxury. They bought Park Place and they bought Larry Miller in Utah. Both of them heavily focused on high volume and luxury. It'll probably insulate them pretty well. Lithia is a little more at risk because they bought a lot of domestic platforms. They bought Suburban in Michigan and, a few others that you wonder what their plan is. But I think what their plan is to mitigate risk by spreading it amongst all their locations. If you got 180 stores and you got 18,000 cars at risk, that's not that many per location. You know what I'm saying?
I understand that. And spreading your risk is a well-proven strategy. There's no doubt about that.
Yeah. No, it's a public company plan.
So Yeah. So what is the what is the thing that's going to happen here where that's going to wake dealers up? Are they becoming aware? I mean, are they? I know it's a whole different group of people, but are they seeing this coming, or is there going to be
No,
no?
I can answer it for you.
Okay.
No.
So
And the
what?
reason that they're not looking at it is because for the first time ever, Jim, ever, they've enjoyed massive profits with the fewest number of cars and the easiest time that they've ever had to make money. In other words, the customer objections are just,
Not there. Yeah.
not there. And so you start looking at it and you go, gosh, I made a lot of money this year. They're not looking at the risk. They're enjoying the fruits of their labor.
Yeah. Yeah. I'm getting a little punch drunk with all that.
Oh boy. I mean, it's
So
easy to become the smartest guy in the room.
when things are going great. Yeah, you bet.
If you're the only guy in the room.
So is there a certain event that could potentially happen in first quarter, sometime in that time frame where
I think it's going to be slow. I think it's like gaining weight, Jim. You don't gain 40 pounds in one day. You gain it 1 pound a week, kind of thing.
I hear
And
you.
I think what we're going to see, there's three things that I call trouble clouds on the horizon. One, is the Fed going to raise interest rates? It's an unknown. We don't know. All indications are that they'll give it a bump.
Yeah.
Okay, so that's a risk, right? Because when Feds raise interest rates, what's that do to consumer rates? They go up. What's already been squeezed out of a vehicle anyway is the affordability factor. Well, you add interest rate increase to a vehicle that's already had the affordability factor squeezed out of it. Now what do you got? Nothing. That's one trouble cloud. Trouble cloud number two. As sure as you and I are sitting here on New Year's Eve, we both know that every manufacturer who gets paid to build cars is going to build cars in 2022.
Yeah.
We know it. It's a foregone conclusion. The question is, at what level will the inventories come back and when? The indicators, again, are you're going to have 1 million more cars by the end of March. That's a trouble cloud because that slow integration of getting vehicles where we no longer have to pre-sell 75% of them and have them come off the truck and they're already sold, you're going to see asphalt quickly get filled up on dealers' lots. That's a trouble cloud because when you're left with new car inventory at almost zero level, you focus on all these other things and make bad decisions just to keep your dealership going. Now, all of a sudden, you got new cars. Now you got the bad decisions you made still sitting. So that's trouble cloud number two. Trouble cloud number three, the lack of auditing any and all of the good processes that we all enjoyed and all worked our butts off until December of 2019. Actually, January of 2020, when COVID actually hit.
Yeah, right.
And you and I both know that most dealers have not looked at their processes since the pandemic.
No, I would agree. Yeah.
Because they didn't have time. They had to pivot quickly to remote retail, which eroded processes to some degree because I had to pivot because I couldn't get people into my dealership. So I had to pivot and make my process remote. Then all of a sudden, the states opened back up. Well, now I've got two processes. I got a remote process and I got an on-site process. Did they match? Did we make sure that we had parity between the two? And then you throw in the pandemonium of, oh my gosh, I don't have any cars. Well, let's just buy everything we can, pay whatever we need to pay, recondition them haphazardly, not worry about aging and holding costs. We wake up and we go, what happened to all of our processes? It's like the guy that weighs 300 pounds and 2 years ago he weighed $180. He goes, what the heck happened?
Yeah.
Well, you did it 1 pound at a time, brother.
That's right.
That's
right. And you keep looking in the mirror going, well, I might put on a couple pounds, but
yeah, but I look okay. You know,
Let's see what you looked like last Christmas on the beach.
Yeah, exactly. Honey, does this make me look fat? You know?
Yeah, I'm into that.
So it's, you know, I don't want to be a negative Nelly, but I want to be a realistic Ron. And, you know, realistic indicators are, and people a lot smarter than you and I are all saying this cannot continue. And it won't. And it's going to be driven by the consumer saying, I'm not buying that car for that money. And it's going to be driven by the manufacturers going, good news, your allocation went from 20 to 100.
Yeah. Okay. Cool. Hey, I thought just came to me, and I'm just sitting here.
By the way, Shift stock in December of last year was trading for $12 a share. It's trading for $3.
For what? 3?
$3.
Goodness. Yeah.
Just as a point of reference on how Wall Street thinks about digital retailers.
Interesting. Okay.
And if you look at Carvana, it's kind of doing the same thing. Although you know, Wall Street loves them, but it was trading. Here's a good example. In August, Carvana stock was trading for $337 a share. Okay. The market closed yesterday. It's trading for $230.
Oh.
Down $100 a share. Analysts are saying it's unsustainable.
Their business model?
Their business models are unsustainable based upon what they have to pay for cars versus what they're retailing for. It's unsustainable.
Yeah.
Stock prices go down based upon analysts going, what's the long-term view of the health of this company? Right?
Yes.
And that's how stocks are priced. That's an indicator in my mind.